Now, part of that was no doubt due to the special singling out of NAB Chair Ken Henry and CEO Andrew Thorburn by Kenneth Hayne at the Royal Commission for, well, let's just say their lack of sensibility. Both resigned. On Thursday, NAB current chief Phil Chronican delivered his results ahead of Ross McEwan taking over as CEO after his 7 years in Britain at RBS, dealing with the fallout from the financial crisis. A lot of customer remediation there too. Well, I put to Phil Chronican, who is now moving up to chair at NAB, that banks face not just a down cycle but structural change, with high fees from wealth gone and new rules on capital, and the dividends will be impacted. I
think, the structure of banking is changing, and we need to adapt our businesses around that. So, we've had to obviously reduce the dividend, which I appreciate is quite disappointing to a number of our shareholders, but we need to get it to a level that's sustainable so that we can make sure we can be clear with our shareholders the level of income they can expect from a bank share, and make sure that we retain enough earnings to be able to deal with the issues that we have to deal with.
Having said that, Phil, your shares are up. Now, that could in part be about your management of costs and what you're saying about cost management going forward. But performance-wise, is NAB now over the worst? Have you reset the slate, as it were, for incoming CEO Ross McEwan?
Well, we've certainly tried to. I don't want to declare complete victory, because there's always issues to deal with in any large business. But we've made a point this year of wanting to address all of the issues of the past and make sure that we're addressing the future. And clearly, with Ross McEwan coming in here in the beginning of December as our new CEO, we want to give him as clear a start as we can and give him the opportunity to help build NAB back into the bank that we think it should be.
You yourself are moving from CEO to chair. You're headed towards an AGM. Now, last year, the first strike against the board's remuneration report was the largest protest vote of any big company ever. Are you confident you won't get a second strike?
Well, that'll be up to the shareholders. They're the ones who get to exercise their vote. All I can say is that we've done everything we can to make sure that we are transparent with our shareholders and are managing the bank as professionally as we can. And what that's meant is that we've made changes to the remuneration scheme, because that was one of the factors last year. Last year there was concern that we'd not listened enough to the shareholders about the amount that we pay to executives.
So what have you done for bonuses, that sort of thing?
So two things. We've, for some of those people last year, we've actually taken back some of the deferred compensation that was awarded last year. And in addition to that, this year there'll be zero in terms of short-term variable reward for the senior leadership.
You are the business bank. Business is your biggest division. Now, you've had growth in your SME business, and indeed you said there's growth to be had. There are challenges, though, out there. What are they? Is it about business confidence? Is it about regulation?
Look, it's a combination, because I think the policy uncertainty, some of the macroeconomic concerns, but also regulation, both on businesses and on banks, are what's holding back business investment. And what we've been saying is that low interest rates have done as much as they can do. We need to look at what are the other issues that are holding businesses back from investing. I mean, the Code of Practice puts a whole lot of additional steps in when people give guarantees, and a lot of businesses, as you'd appreciate, take director guarantees or family guarantees. That process is now more complex. Yes, when you put up the house for a small business loan, you've got to look at the responsible lending obligations that go with that, so that's slowed the process down. But as I said, it's also about making sure our businesses are confident to want to borrow in the first place, and making sure we can help them drive the demand for borrowing as well as the supply.
On the consumer banking side, your mortgage growth was quite disappointing, but you're expecting better, are you?
Yes, we had a good first half. We had a weak second half. In fact, the home loans book went backwards in the second half. But towards the end of the second half, we had some good positive momentum. So we've been looking again at all of the things that get in the way of our people supporting customers who want to borrow to buy a house, and trying to make that work. So in the last few weeks of the year, coming into October, we've had some pretty good weeks in terms of new lending, but we've got to wait and see that flow through the book.
Now, obviously there have been 3 rate cuts, which I think have cost you about $200 million. How is your message getting through to customers as to why you can't pass the full RBA rate cut through?
I think we've had this debate in the public for a long time, but obviously as interest rates come down, there's a limit to how much we can reduce deposit interest rates. So we reduce the rates to our borrowers, but we can't reduce the rates to depositors because in many cases the rates are already very low and there's no real basis for taking them below
Do you think
zero.
the message is getting through?
Well, I don't know, but the more opportunity I have to pass it out, the more it's there. So even though, in the eyes of some people, when we didn't flow through a whole 25 basis point rate reduction, they think that we're holding it for ourselves. Actually, we're losing as well. Our shareholders lose money out of that equation. Because we're putting real pressure on the deposit book. So bank profitability is challenged in a low-rate environment.
The other challenge is the amount of Tier 1 capital that you're being asked to raise. Now, you've announced your dividend reinvestment plan today. Some thought there might be a separate capital raising, but you are comfortable that you will achieve easily the 10.5% limit.
Yeah, so we ended the year just below 10.4. With the dividend reinvestment plan and the underwriting of that today, that'll take us, once that's complete in the next month or so, that'll take us to about 10.75, so well ahead of the 10.5 that APRA was requiring.
Now, what are you going to do when the New Zealand regulator, who obviously feels that Australia won't bail them out if there were a banking crisis, what are you going to do if the regulator comes down with much stricter capital requirements on its side of the ditch? It might lead to you lowering investment in New Zealand, you've basically said today.
Well, I think what we have to understand here is that if you, as their initial proposal put it, if you double the amount of capital required to support banking in New Zealand, then actually there'll be less of it. It won't be just us lowering our investment. There'll be less demand for credit in New Zealand. So we need to look at how that would play out. But the Reserve Bank of New Zealand has been open to conversations around over what time frame these issues might be phased in, what instruments might apply. So I think it's a little stark just to say that capital is going to suddenly double. That's not the way I think that they are envisaging this happening.
I just wonder what you make of Joe Healy, the former head of business banking at NAB, also behind the new disruptor bank Judo. He talks about bankers becoming like car salesmen with sales targets in his book. He says that banks should be broken up and they've lost the craft of banking and the ability to read customer risk. What do you think of his comments?
I've known Joseph a long time, but I'm not that close to his experiences. Obviously, he was here at NAB, and we did our own assessment of the cultural failings and the issues at NAB, and we published that in our APRA self-assessment document this time last year. So I don't think breaking up banks is what the Australian economy needs. I think the Australian economy does need strong banks, and banks that have the risk absorption capacity that our large balance sheets hold. But I think what we've identified in our self-assessment document is that there are some cultural issues that needed to be addressed, and they do cut to remuneration and they do cut to the way people see their role and the incentives around it.
So you see this very much as under new management, yourself and Ross McEwen, Phil Chronican and Ross McEwen, new team, new management. New challenge.
New team, new challenge, and Ross and I have had obviously a large number of conversations, and I think we've got a good alignment around the type of bank we would like to build.
Phil Chronican, thank you so much for your time.